Welcome to Module 8. At the end of this module, participants should be able to explain the core principles of the RBA and its legal basis in RPC 2023. Identify and categorize key risk factors, geographic, client, service-based. Apply the 8-step risk mitigation process to real-world transactions. Develop and document internal controls, including training programs. Recognize red flags and escalate high-risk matters appropriately. Demonstrate compliance through records and affidavits. This module explores the risk-based approach, RBA, as outlined in Chapter 2 of the Rules of Professional Conduct for Legal Practitioners, 2023. The RBA mandates legal practitioners to identify, assess, mitigate, and manage risks related to money laundering, ML, terrorism financing, TF, and proliferation financing, PF. It shifts from a rigid compliance model to a flexible, proportionate one, where resources are allocated based on risk levels. The RBA aligns with Nigeria's Money Laundering, Prevention and Prohibition Act 2022 and international standards from the Financial Action Task Force. The approach emphasizes understanding vulnerabilities in legal services, such as corporate formations, real estate transactions, and trust management. By adopting RBA, practitioners comply with ethical obligations and protect their firms from reputational damage, regulatory sanctions, and criminal liability. The RBA requires a dynamic evaluation of risks rather than a static checklist. Under Rule 61.1, practitioners must identify potential vulnerabilities, such as unexplained wealth in a high-value property deal. Assess the likelihood and impact. For example, high likelihood if involving a politically exposed person, PEP. Understand risks within the firm's services and Nigeria's economic landscape. Rule 61.2 mandates creating effective control mechanisms to mitigate risks, such as tiered due diligence levels, simplified due diligence, SDD, for low-risk clients, client due diligence, CDD, for standard risks, enhanced due diligence, EDD, for high-risk clients. In Nigeria, where MLTF risks are elevated due to corruption, oil theft, and cybercrime, RBA ensures efficient resource use. Non-compliance can lead to NBA disciplinary proceedings or EFCC investigations. Firms must establish robust systems to support RBA implementation. Rule 61.3 requires developing written AML-CFT policies, procedures, and controls. Screening new hires for AML knowledge through background checks or certifications. Providing ongoing, role-specific employee training, such as annual workshops and quarterly updates. Implementation tips include appointing an AML compliance officer for firms, regular AML-CFT-PF training, integrating RBA into performance reviews to ensure accountability. Rule 61.4 outlines steps to minimize risks, while Rule 61.5 details 8 mandatory actions. Client identification and verification, CDD basics, Rule 61.5a. Verify identity using reliable documents such as NIN or CAC certificates. Ascertain beneficial owners and true beneficiaries. Understand the source of funds and wealth. Understand service nature and potential risks, Rule 61.5b. Analyze how the service could obscure illicit funds. Mitigate risks by restructuring or adding safeguards. Seek expertise or decline instructions, Rule 61.5c. Consult specialists or reject instructions if risks exceed expertise. Assess transaction rationale, Rule 61.5d. Probe the logic of the transaction to ensure plausibility. Vigilance for red flags and suspicion indicators, Rule 61.5e. Monitor for grounds to suspect crime or TF. Document reviews to demonstrate compliance. Develop action plans, Rule 61.5f. Plan responses such as EDD or NBAA-MLC consultation. Determine evidence and documentation levels, Rule 61.5g. High-risk cases require audited financials, while low-risk cases may suffice with self-declarations. Adequate documentation and records, Rule 61.5h. Record all steps for at least 5 years. There is no exhaustive list under the risk categories. Lawyers should use examples contextually, while smaller firms can focus on services. Methodologies can be applied flexibly across different practice sizes. A. Geographic country risks, Rule 63. This risk pertains to a lawyer or law firm involved in a cross-border transaction. You are expected to carry out a proper risk assessment on the geographic or country risk involved or likely to be involved in the transaction. Assess the cross-border elements, including where the client is domiciled, the location of the transaction, and the source of the funds or wealth. Higher risk indicators include countries identified for terrorism support, identified as corruption hotspots, those under sanctions, or those with weak governance or AML regimes. Evidence of compliance, Rule 63, 4. A lawyer satisfies the obligation to assess geographic risk by showing a compliance document detailing their review and understanding of such risk in the engagement. B. Client risks, Rule 64. This risk pertains to exposure a lawyer or law firm faces by virtue of a client or category of clients. You are expected to carry out a proper risk assessment on the client risk involved or likely to be involved in the transaction. High-risk clients include politically exposed persons, PEPs, and persons closely associated with or related to PEPs. Clients requesting services in unusual or unconventional circumstances. Clients where the structure of the entity is obscure or the true beneficial owner is not easily discernible. Entities involving unexplained use of shell companies, front companies, or assets split across different countries without apparent legal or business reason. Clients using informal arrangements, such as family or close associates acting as nominee shareholders or directors. Clients with unusual complexity in control or ownership structures without a clear explanation. Companies that operate a considerable part of their business or have major subsidiaries in countries posing higher geographic risk. Cash or cash equivalent intensive businesses, such as remittance houses, bureau de change, virtual asset providers, casinos, and gambling-related institutions. Businesses that rely heavily on new technologies. Unincorporated charities and not-for-profit organizations, NPOs, not subject to supervision, especially those operating on a cross-border basis. Clients using financial intermediaries and financial institutions. Clients appearing to act on somebody else's instructions without disclosing that person's identity. Clients who actively avoid face-to-face meetings or provide instructions intermittently without being easily reachable. Clients requesting transactions be completed in unusually tight or accelerated timeframes without reasonable explanation. Clients who have no address or multiple addresses without legitimate reasons. Clients with funds obviously and inexplicably disproportionate to their age, income, occupation, or wealth. Clients who change their means of payment last minute without justification, or where there is an unexplained lack of transparency. Clients suspected of engaging in falsifying activities, such as false loans or invoices, with indicators of tax evasion. The transfer of a company seat to another jurisdiction without genuine economic activity, risking the creation of shell companies. Sudden activity from a previously dormant client without clear explanation. Situations where the reason for choosing the law firm is unclear given the firm's size, location, or specialization. Clients with frequent or unexplained changes of professional advisors or management. Clients reluctant to provide relevant information or where there is reasonable doubt that provided information is correct. Note on fees. Clients who offer to pay unusually high but bona fide and appropriate premium or significant contingency fee arrangements should ordinarily not be considered a risk. Evidence of compliance. Rule 64, 4. A lawyer satisfies the obligation to assess client risk by showing a compliance document of their review and understanding. Additionally, they must provide an affidavit on oath from the client attesting to the genuineness of the transaction and the source of funds. That concludes our exploration of the risk-based approach. By applying these principles, you're not only ensuring compliance, but also safeguarding your practice and contributing to a more transparent legal profession. Thank you.